Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Academy Sports stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a mid-cap company, 3.7 billion market cap. They're trading at $50 a share and they have 74 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have the most free cash flow in 2021, close to $1 billion. It dropped to $600 million in 2022, dropped to $440 million in 2023, and now it's $370 million in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. That peaks in 2022 at $670 million. It's pretty steady after that, $612 million in the trailing 12 months. Revenue is a sales for the company, and that goes up nicely from $5.7 billion to $6.8 billion. But then it declined. It's $6.5 billion in the trailing 12 months. Most companies' revenue has increased due to inflation. In this case, they've decreased. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's $11 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $9.8 billion. We divide that by 74 million shares. And we get a calculated stock price of $132. They're trading at 50, so they're trading at a 62% discount. It's a really strong buy according to the model. I do believe their future free cash flows are appropriate, maybe a little aggressive, but even if you scale it down a bit, they're still pretty undervalued. That's the hard part about investing. Sometimes a stock appears really undervalued, but it doesn't ever seem to go up. And some stocks appear to be really overvalued, like Tesla, and they always go up. They don't seem to come down that much. So who knows? I'm still trying to figure out myself. There are 45 companies in the same industry as ASO, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. In terms of CapEx, they spend $168 million. These are investments in property, plant, and equipment. When a company invests in CapEx, like for instance O'Reilly Automotive, say they open a new location and they buy the real estate for $5 million. That's CapEx. It's carried on the balance sheet and depreciated over its useful life. Their debt to equity ratio is better than the median, a lot better than the average. It's 1.0, which implies their debt is equal to their equity. They do pay a dividend, although pretty small, 0.7%. Best Buy is the largest at 5.3%. I think that's mainly because Best Buy stock has come down so much. When a stock price comes down, the yield goes up. They generate $370 million of free cash flow. O'Reilly is number 1 at $2.4 billion. They rank 17th in market cap, $3.6 billion. Average $6.5 billion, median $1.2 billion. They have a really good price to book, 2.2, a little worse than the median, a lot better than the average. Advanced Auto Parts is the best at 1.2. They have the best PE of all these companies. They have 5.9. The average is 19, median is 15. This means investors are paying $5.90 for $1 of earnings. The lower the better for this ratio. They have a really good price to free cash flow and price to sales, better than the median. ODP is number 1 in that category. Their revenue is a little better than the average, a lot better than the median. Best Buy is number 1 at $44 billion, a lot bigger than everybody else. Number 2 is Murphy USA. Murphy USA is a spin-off of Murphy Oil. They operate retail gas stations. Most of those gas stations are near Walmart. When I opened my first brick and mortar business, my goal was to be near a Starbucks. Because Starbucks did all the work to find a location. They looked into the demographics, the earnings power of the population, so I don't really need to do any of the work. I just have to put my business near theirs. We can't look at their 5-year annual revenue growth rate. We don't have that information. Five Below is number 1 at 18%. They're growing quite a bit. The average is 6%. Same thing with the median. Let's go through their most recent 10Q. We'll look at their income statement, then their balance sheet, then their statement of cash flows. So the income statement, this is for the quarter ending 7/29, and this column here is a 6 months ending 7/29, and they compare it to the prior year, 2022. So for the 3 months ending 7/29/2023, revenue of $1.6 billion, down from $1.7 billion. Let's get a breakdown of the $1.6 billion so we know what it is. We'll just search that number. Of the $1.6 billion, $430 million is outdoors, $390 million sports and recreation, $446 million of apparel, that's clothing, $300 million of footwear. And it's down in every category when you compare it to last year. Down the most in outdoors. It was over $490 million, now it's only $430 million. Down $60 million year over year. Same thing for the trailing 6 months, down in every category from 2022. Let's go back to the income statement. All the expenses directly related to generating the revenue are cost of goods sold. That's a little over $1 billion. The payroll for the labor, the cost of the materials, the rent for the retail stores. So they have a decent gross margin, $560 million. That's about 30%. So they convert roughly 1/3 of their revenue into gross profit. SG&A are all the expenses not directly related to generating the revenue. For example, marketing, the payroll for its executives, that's $350 million. Operating income, $210 million, down from $256 million. They spent $11 million of interest on their debt. They had $3.6 million of income from other, $46 million of taxes, so their net income is $157 million. EPS of 206, that's down from 228. They are buying back lots of stock. Last year they had 83 million shares outstanding, now they have 76 million. So they bought back 6 million shares, which is about 7.5% of their total shares outstanding. That's like a 7.5% dividend when they buy back so much stock. Here's the income statement with percentages. These percentages are as of their revenue. So for their gross profit, that's 36%. That's gross profit over revenue. It was similar to last year. Operating profit of 13%, that's down a lot from last year. Last year was 15%. Because their SG&A is up a lot. It's up over 2% from last year. It's 22.3% compared to 20% from last year. And their net profit margin is below 10%. It's 9.9%. It was 11.2% last year. So they're much less profitable this year than last year. But that happens a lot with inflation. Once they adjust their prices, then they should bring their margins back up. Let's take a look at their balance sheet. This is their balance sheet as of 7/29/2023, 1/28/2023, and a year ago at 7/30/2022. Current assets of $1.7 billion, current liabilities of $1 billion, so their current ratio is 1.7. They can easily cover their current liabilities with their current assets. Most of their current assets is inventory, which is expected. A company like this has to sit on a lot of inventory, $1.3 billion. In their non-current assets, they have $1 billion of right-of-use assets. These are assets that are owned by another company that they lease. $400 million of property and equipment, $860 million of goodwill. Goodwill is the premium you pay when you acquire another company. So total assets $4.7 billion, almost identical to last year. They have $669 million of accounts payable. This is how much money they owe other companies for buying on credit. $580 million of long-term debt. Let's get a breakdown of this number. $400 million is a note that's due in 2027, and $193 million of that debt is a term loan also due in 2027. If you want to know the interest rate on this debt, you can scroll down a little and it talks about it. On November 2020, they entered into a 7-year $400 million senior secured term loan. That's at a rate of LIBOR plus 3.75%. It looks like there's more variations to that interest rate. The weighted average interest rate was 8.9%. That's pretty high. Because it's adjustable, it's based off of LIBOR. If it was a flat interest rate, it'd probably be like 3 or 4%. Because in 2020, rates were a lot lower than they are now. Let's go back to the balance sheet. They have retained earnings of $1.5 billion. This is their historical profits. Retained earnings is the sum of all their prior net incomes minus the sum of the dividends they paid out. Additional paid in capital is how much money they raised from issuing stock. It looks like they buy back lots of stock, so that does lower their equity when they buy back stock. Let's take a look at the statement of cash flows. This is for the 6 months ending 7/29/2023. And the way you calculate operating cash flow, you start with your net income of $250 million. You add back non-cash items on the income statement. We add back $52 million to depreciation. We add back $20 million of stock-based compensation. They call it equity compensation. We have to adjust for changes in working capital. They had a cash outflow of $26 million on inventory. So when a company buys inventory, they use cash, so it's a negative in cash. But when they sell that inventory, it's a cash inflow. Last year, they spent $130 million more in inventory than they sold. So their operating cash flow is pretty similar to their net income. You would expect operating cash flow to be higher. Same thing last year, their operating cash flow was less than their net income, a lot less. In their investing section, they spent $110 million on a purchase of CapEx. So they may have opened a bunch of stores. Last year was only $48 million. In their financing section, they spent $156 million in stock buybacks. Last year, $288 million. Let's take a look at the company on Simply Wall Street. Its last price was $50, market cap $3.7 billion, flat in the past week, down 3.5% in the past year. Let's learn a little more about the company. Academy Sports and Outdoors operates as a sporting goods and outdoor recreational retailer in the U.S. Their outdoor division sells camping products such as coolers and drinkware, camping accessories and equipment, sunglasses, backpacks, and sports bags. Fishing products including marine equipment and fishing rods, reels and baits and equipment. Also hunting products, which includes firearms, ammunition, archery, and archery equipment. Camouflage apparel, shooting accessories, optics, air guns, and hunting equipment. Their sport and recreation division offers fitness equipment, fitness accessories, and nutrition supplies. Their team and specialty sports equipment includes baseball, football, basketball, soccer, golf, racket sports, and volleyball. They also sell patio furniture, outdoor cooking, trampolines, play seats, water sports, and pet equipment, as well as wheeled goods including bicycles, skateboards, and other ride-on toys. Electronics, watches, and front-end products such as consumables, batteries, etc. The company's apparel division provides a range of products, including outdoor and seasonal apparel, denim, work apparel, graphic t-shirts and accessories, boys and girls outdoor and athletic apparel, sporting and fitness apparel. They also sell college and professional licensed apparel and accessories. Their footwear division offers casual shoes, slippers, seasonal footwear and socks, work and western boots, shoes and hunting footwear, boys and girls athletic footwear, running shoes, athletic lifestyle and training shoes, and team and specialty sports footwear and slides. They sell their products under the Academy Sports and Outdoors, Magellan Outdoors, BC, Outrageous, Game Winner, Outdoor Gourmet, and Freely branded names. They were founded in 1938, headquartered in Katy, Texas. It looks like they started trading at the end of 2020, and the stock was at its lowest point at $13 a share. And it did really well for the next 3 years, peaking at 68 in April 2023. It is down to below 50, so you could get it at a 15% discount to its all-time high. And it looks like it has lots of room to grow. Simply Wall Street is also bullish on this one. They're at $87 a share. They say the stock is 43% undervalued. 18 analysts price this stock at $67. They also say the stock is undervalued. Their revenue was $4.8 billion in 2018. It grew about 50% to $6.8 billion. That was in January 2022. That's their trailing 12-month revenue. But it is down. It's down to $6.2 billion. Their revenue forecast for 2026 is $7.3 billion, which I think is definitely doable. They had debt of $1.6 billion in 2019. It peaked at $2 billion in 2020. When a company IPOs, they get lots of cash. And often, companies pay down debt with that cash, which is what they did. And they brought their debt down to below $800 million. And it's even lower now. It's $586 million. And you can see their equity was lower than their debt in 2019. Now their equity is much higher than their debt. So they seem to be doing a good job growing their business. And they do have a good amount of cash also. Currently they have $311 million of cash. So they have a pretty good runway of cash, and they're profitable. So there's not too much of a concern of them going bankrupt. This purple line is their dividend payout, and you can see it's gone up. It's up to 36 cents in the beginning of 2023, and the forecast is for them to pay 45 cents by 2026, which would give them a yield of 0.9%. Still a pretty low yield. The CEO, Steve Lawrence, has been with the company under 1 year. His total compensation is $2.6 million. His salary is $770,000. And this is not a good sign. There's only insider selling in the past year. There's no buying. About 180,000 shares have been sold in the past year. Almost all the companies owned by institutions, a small amount by insiders. BlackRock is their biggest shareholder at 15.5%, then Fidelity at 13.5%, Vanguard at 11.7%. Lots of big companies own them. T. Rowe Price 1.3%, Morgan Stanley 1.2%. BNY Mellon, also AllianceBernstein, both at 1%. Their employee count is pretty steady over the years. It was 16,000 in 2020. Then it went up and down, up and down. It's currently at 22,000. And the stock only trades in two places, the NASDAQ and Sao Paulo Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.